Hey everyone, welcome back to a tutorial. So in this case, we are going to learn about the accounting equation, which is basically the basic of accounting. So the accounting equation consists of three things. And if you can master these, then you're good to go. The first thing it deals with is assets, right? So what are assets? Assets is basically what the business owns. Okay. The second one is liability. Liability is what the business is indebted in, right? So what it owes to other external people. And we will talk about examples. Think about suppliers or rather creditors as you go. Think about bank in terms of maybe a business takes a loan, for example. And then the third thing is equity. Okay, so this is more of what I want you to think about in the back of your mind as capital or an investment. Okay, so an owner can invest in the business in cash or in asset. Okay, so here's an example that you can have a look at. A business has a laptop, owes the bank money, and the owner puts the cash. Those three things. The first thing is an asset, a laptop. The second thing, the business owes bank the money. That is a liability. And now the owner puts cash into the business. That is equity. There is a formula that you have to always consistently apply whenever you deal with an accounting equation. Okay, you need to know that formula. Very important, that formula needs to balance. Never let go of a transaction that does not balance. Always verify, does my accounting equation in balance? Okay, and this is the formula. Assets is equal to liabilities plus equity. That should be consistent, right? So what do I mean when I say it has to balance? Suppose you have a negative amount on the assets. When you combine your liability and equity, it has to give you the same negative amount that you have on your assets. And the opposite applies when you have a positive amount. Okay, we will do examples, just bear with me. Right, let's unpack different examples of assets. Like I said, it's what the business owns, right? So there's different types of examples. It could be cash, it could be a bank, inventory. What are those? Those are current assets. I don't want us to look at deep into current assets or non-current assets. I just want us to know the examples, okay? However, we will be unpacking how different assets are in the next lesson. So it's cash, bank or inventory, equipment, computers, machines, vehicles, and data. So basically, those are the general and rather main examples of assets. Let's now have a look at liabilities. So liabilities, like I said, is what the business owes to external parties. So if you think about it, a loan that we owe to a bank, a creditor that we take inventory from using credit, a tax that we need to pay to source, any expense that is not yet paid, even if we have a bank overdraft, that becomes a liability. Once again, we have short and long-term liabilities, and we will unpack that later. The third thing is equity. When I talked about equity, I said I want you to think about what? Capital and investment. Okay? That is what equity is. However, as you expand your accounting knowledge, you would understand that there are cases whereby there is profit that is there. Literally, it's there in the business, and the business has done paying their expenses, they've paid their taxes, they even paid dividends to their shareholders. And what is left is just profit lying there. Now, if we have such profit, we can actually invest it, and we refer to it as retained profits. But that is for later. You just need to know what the retained profits means as under equity. Whenever an owner, for example, in a small business would take money for personal use, that would be referred to as drawings. So just keep that in mind. Back to the rule. Your accounting equation needs to be in balance. And as you go, you will hear terms that says your debit has to have a credit. Your debit has to have a credit. What's on your left has to be on your right. That must be consistent. Anywhere where you deal with accounting transactions. Let's look at our first example over here. We have a scenario that says the business buys stock on credit for 8,000. Okay. Now the keyword there is stock and credit. And by the look of things, you can already know that a stock is an asset, which is an example that we did. So stock is coming into the business. Automatically, I know that my asset is going to go up because inventory is coming in the business. So you go to your asset and you put a plus 8,000. However, remember the rule. What you put on the left has to be on the right. You use the keyword credit right there. What does it say? It says that this stock was bought on credit. By the look of things, it should ring a bell in your mind that the people that you buy credit from are your creditors. So therefore, you will have liabilities because now you owe money in as much as you got the inventory. So your liability will be a plus sign. And then ask yourself, is this a capital or an investment? Absolutely not. So on your equity, you just put 0. And then your accounting equation will be in balance. Let's have a look at the next example, which is probably the last one. In this case, the business buys equipment for 20,000 cash. Okay. Right. Find the keyword right there. The keyword is equipment. That is an asset. Then you know I have to do something on my asset. Then of course another keyword right there is cash. right? What happens? You have a movement of money in the business. You go to your assets, then you ask yourself, what is happening right there? Equipment is coming in the business. So therefore, your asset value are going to go up with a 20,000 amount, right? But then, of course, I want you to think about it on different scenarios. Suppose that this was the equipment that was brought in by the owner. It would have been capital under equity. Okay, but however, in a bank, or rather introducing bank in the transaction, then of course the 20,000 would decrease the bank. Is it a liability? No. So you put 0 there. So in this case, we are working with a bank transaction. So going back to our example, a bank is also an asset. So when money goes out, it will decrease. Then you also have an equipment that increases the asset. So if you put the two together, the net effect will be 0 on the asset, because you are just losing money to gain an asset. So it's you losing cash for value, basically. Another example, and we'll have to close our session with this one. It says the owner starts the business with 50,000 cash. Okay. The keyword right there is the owner. The owner is the person who started the business. Okay. And another keyword is cash. So, by the look of things, right? You understand what an asset is, you understand what a liability is, and you understand what an equity is. An equity is a capital or an investment. So now we have an owner who invests money in the business. What does this tell you? It tells you that this person is investing in the business in a form of capital. So you go to your equity and then you indicate that your equity is increasing with 50,000. Is this person taking a credit? No. So you will have nothing on liability. That is straightforward. But then ask yourself this practical question. Money is going inside the bank of the business because it has been invested by the owner. And then what is bank? Bank is an asset. So this means that bank will increase with a 50,000 cash. So you have to go to your asset and ensure that you also put a plus 50,000. Once again, consistency is important. As you do your accounting equation, you apply the rule. Verify, is my left side equal to the right side? And that's basically it with the basic principles of accounting equation. In the next lesson, hopefully we will be unpacking different types of assets and different types of liabilities, because it's very, very important to know how different they are, especially in terms of time and in terms of how they affect the business. Otherwise, thank you so much. I will see you in the next lesson.